Hey Group 7, so just going to go over exercise 4.2 in module, I think it's 2.3. I recommend you watch my video first on exercise 4.1 in the textbook. It should hopefully be uploaded before this video, but this one is specifically for Christy to make sure that everyone gets all this. So basically this is very similar to the exercise we just did in the worksheet. All we're doing is classifying the transactions but not putting it into the actual worksheet itself. So which is the exercise 4.1 in the textbook. So I'm going to just quickly go through all of this. Just a quick refresher, what I mentioned right at the start. Remember, we've got 5 accounts. We've got our liabilities, assets, revenue, expense, and equity. Our liability analysis, that's our balance sheet, revenue and expense, P&L, and then our equity kind of floats between the two. Easiest way to remember it. And then those 5 accounts, they've all got different types of nature. You've got a credit nature or a debit nature. So if you remember, liability is credit, asset is debit, revenue is credit, expense is debit, equity is credit. I'll put it all down below. So all this question is asking is to state the effect of the business transactions for Humphrey Sports. So you've just got to figure out, remember, there's 2 sides to every transaction, 2 sides to every story. So that's what we've got to do. We've got to figure out what are the 2 sides. So I'll do this fairly quickly so it's not long-winded because it's fairly simple. But yeah, so exercise 1, commence business injecting cash into her business. So your effect is equity increasing, cash increasing. How can 2 accounts increase at the same time? Equity is credit nature and cash, it's an asset, it's also debit nature. So because they're both credit and debit, they can both increase. Cool. It also has no impact to your P&L. Paid wages. Wages is an expense, it's going up. Cash is an asset, it's going down. So it does impact your P&L by going down by the value of the wages. Question number 3, sold goods on credit. So you've got your accounts receivable. So that means what receivable? You're going to receive money. So you've sold your goods, you're going to receive money. Okay. So accounts receivable goes up, and then also your revenue goes up. So it does impact your P&L by the revenue portion. They're going to be the same value. If it was you sold goods for $1,000, they both go up by $1,000, and later on you record the cash transaction, which will decrease accounts receivables and increase your cash. But that impacts your balance sheet, not your P&L. Exercise 4, purchase goods for sale on credit. Similar thing, but this is accounts payable because we're going to pay money. Accounts payable is a liability. So accounts payable goes up, accounts payable goes up, and then your goods, which is classified as an asset, goes up at the same time. Remember, accounts payable is a liability, credit nature, goods, which is an asset, has a debit nature. They can both go up at the same time, and they both can go down at the same time, and they can go up in that way. If they're both credit accounts, credit nature accounts, they can't go up at the same time. They always have to have an inverse relationship. Because they're both liability assets, balance sheet, no impact on the P&L. Question 5, received an invoice for annual insurance on a building and paid the account. That is, insurance is an expense. So increase of an expense, and then we have got decrease of cash, expense. That is on our impacts, our P&L, and it's a decrease because the cash is going out. So that's a decrease of however much the insurance cost on the P&L. Exercise 6. Jay Humphrey, who we presume is the director of the company, withdrew an iPad from the business. So iPad, it's an asset, so it's a decrease in the asset, and also so equity, so we would reduce that because the director is pulling something out. That means whatever he's given is going to decrease by the value of the iPad, if that makes sense. They're both balance sheet, so it's no impact on your P&L. right? Sold inventory for cash, two parts for this. So just trying to figure out the best way to explain it. Your first part of your transaction is the sale of the actual goods. So you've got increase in cash, which is your asset, and increase of revenue. So the increase of revenue is impacting on your P&L. At the same time, we've got cost of goods sold. So if you remember how a balance sheet works, we've got revenue less cost of goods sold equals gross profit minus expenses equals net profit or loss. So there, when we've recorded out part one, part two is decrease in inventory, increase of cost of goods sold, sorry, had to think of that. Cost of goods sold is an expense, so it's going to have a negative impact on your P&L. Okay, hope that makes sense. Question 8, accounts receivable, and you paid the amount outstanding, so accounts receivable goes down, and you're increasing cash. So accounts receivable is money coming in. Sorry about my brain thinking. So that's how that one works. And that will have an impact. No, it won't have an impact on your P&L because they're both asset nature, so it's balance sheet only. Humphrey Sports paid accounts payable in full, so cash goes down, accounts payable goes up. Again, it's an asset and a liability, so that's your balance sheet, no impact on profit and loss. So sorry about my brain processing some of that, but hopefully that all makes sense. Make sure you listen to the video that explains exercise 4.1. That will hopefully give you a bit more information, but I hope that helps a lot. It's a bit tricky to get your head around. It still bamboozles my mind sometimes, so if you're struggling, reach out. Happy to do videos, happy to explain it more, but don't feel bad if you're finding it a bit of a struggle, because it's not easy. I've been doing this for so long and I still get so confused. So if I get confused, don't get stressed out. You will get the hang of it. It's just kind of like coding transactions and figuring out how a transaction falls. You'll get used to it. All right, see ya. Bye.